Welcome to your Money Matters show. This is your weekly show on everything related to money. So far, we have covered a great deal from PPI to illegal lenders, from consumer credit, and of course, there are plenty of topics that I have forgotten to explain. But on this show with me, Ripon, today I'll be talking about mortgages. I'll be talking about ways to get it, how to get it, the challenges you'll be facing while you are making perhaps your first application for a mortgage. And no doubt, there are occasions where you find yourself in financial difficulties. When you do, what options are there? What avenues available to you? Those are among many that I'll be exploring. So, in this studio on Betar Bangla, we have Robert Parker, who is an independent financial advisor and has been practicing for many years, and he is now also chair of Personal Finance Society, that is a charity but trains all the financial advisors and planners in the country. So clearly he has a wealth of experience. But it's probably helpful for us to hear from him in terms of what he does and the role of Personal Finance Society. And of course, then we'll move on to talk about your prime interest in getting into the property ladder. So Robert, are you in the studio?
I am indeed. Hello, Ripon. It's lovely to be here again. It's good to see you.
Robert, thank you for taking part. So from your experience, why is it a hype to start with? Why is it a hype for us wanting to get onto the property ladder?
Well, there are a number of difficulties in buying a property. Now, traditionally in England, it's always been a thing that you're encouraged to buy property rather than rent it. In many other countries, France and Germany, people are encouraged to rent. Relatively few people own property. They own it more as an investment. Here, you're very much encouraged to actually have your own property. The difficulty that it often faces many young people, and this has always been the case, that when you're actually starting out first, house prices, particularly in this area, are very high. So you have to spend some time saving or getting a deposit together, first of all, to actually buy the house, and then also be in a position that your job is good enough to actually support the paying of a mortgage. So in other words, you've got enough what we call surplus income, enough spare income to actually go ahead and pay for the mortgage and be sure you can pay it safely without having to worry about other things.
Okay, I mean, we'll go into ways to get mortgage and how to get it. But of course, you're an independent financial advisor
Yes.
who advises in ways people to perhaps, or the industry that you work in advises
That's
how
right,
to get a
yes.
mortgage. So what is the role of an advisor in that context?
The, the the financial advisor is actually quite important in this context. Often when you want to go and get a mortgage, now there are many ways of getting a mortgage, and it's perfectly fine to walk into the bank. They're very well qualified and capable. Building societies, which are organisations which are there to lend for the buying of houses, are very good. And other people come to us as financial advisors. Now, why they would come to us is that, for instance, if you go into one bank or one building society, they'll tell you all about what they can do, and it's often very good. But we'll look at maybe 100 banks or building societies for you to find the best mortgage for you. Now, by the best one, it may be the cheapest, it may be one that helps you pay the house off more quickly, but it will be the one that suits you, and that's what the financial advisor does. So the financial advisor looks at this, looks at what you're earning, looks at how much deposit you can put down, or whether you need help in other ways from, let's say, housing associations or other organisations that can help you find deposit at the beginning. And then we look at that, put it all together, and hopefully find the right mortgage so you can have a house and enjoy it and not have to worry about money while you're doing it.
Fair enough. But in terms of, let's say, the training itself, the
Yes.
financial advisor undergoes, I mean, how do I know that you're trained very well and trained effectively in order for you to give me that fantastic financial advice that I'm looking for?
Yes. Today, an independent financial advisor or any financial advisor has to be properly qualified. If he doesn't meet the qualification standards and he's not registered with the Financial Conduct Authority, he isn't trading legally and can be in a great deal of trouble. So, in order to give the advice, we have to have passed certain exams, which are provided by my professional body, among others, and we also have to be able to show that we meet a certain standard where we check regularly and make sure we do certain things so we understand everything. And in order to do that, we then get to the qualification. So you have a qualification at the end of your name, which talks about mortgage advice. So it might be a qualification will say, we have a word called DIP PFS, which is our one of our basic qualifications.
What's DIP?
PFS, personal finance, the Diploma of the Personal Finance Society,
Right, okay.
is a practicing qualification, and just behind it, will have something like CERTS, CII, MP, which is mortgage professional, or another word, SIPFA. There are different ones, but they're recognisable mortgage qualifications, and you can look on the internet and check that the person is qualified.
Okay, so you've got the certificate to show that you're
Yes.
qualified, but is that the only thing that matters? How about practical experience?
Well, this is the thing, that in order to meet a good qualification standard, you need to have worked and understood the mortgage market, and also had people in front of you that you can talk about mortgages with, and work steadily with somebody else until you've actually got the skill to arrange a mortgage properly. So an advisor goes through a basic training process where they build up their skills under the supervision of other financial advisors.
Right.
Then they become what's called a competent advisor, and when they have that status, they can go along and see people and talk all about mortgages then.
Perfect. So then what role does the Personal Finance Society play in that context?
Now, the Personal Finance Society is the main professional body for financial advisors. There are some other institutes that also help provide financial advice, of which the main one is the Institute of Financial Services. But the Personal Finance Society is the lead professional body that is incorporated by Royal Charter from the Queen, and we give the qualifications to the financial advisors and set the professional exams, which are the main ones as benchmark for giving financial advice.
So since the topic is about mortgage,
Yes.
let's go back to the topic mortgage.
Absolutely.
So so now, yes, I'm desperate for a mortgage. I
Okay,
want a mortgage because I think this is the way to go. The whole
Yes.
nation being sold to be, buyers of properties, and this is the way things are going. So
Of course. And generally it's a good thing, of course, because if you own your own property, you're not having to pay rent on it. You can look after it. You benefit from the growth in the value of the property.
absolutely. So when it comes to making an application, lead me the way. What
Okay.
is the process that I need to follow to get a fantastic deal for a mortgage?
Okay. Well, first thing, if you came to see me, we talk about, well, what sort of house do you want? What are you looking for? Now, that might be different from one person to another.
Absolutely.
So one person may want just a simple flat that they're happy with, and it would suit a single person to go and do things and build up from. Another person, of course, might have a family.
Absolutely.
So they would look for a house, perhaps near a school or something of that sort. So first of all, we find out what sort of house the person's looking for, and from that we work out what sort of price band they're going to need to be looking in the first place.
So price means the value of the property.
The value of the property is the first thing. So we then establish the sort of property that they would really want to have in the first place. Now, we look at that, so that's perhaps some would say a funny way of looking at it, but of course we need to see what you want first. That's the most important thing. It's what you need and what you want is the thing a financial advisor looks for, not what we can sell you. We want you to find out what you want. Once we understand a bit more about you, and of course we'll ask you about your job, how much you earn, if you're married, how much your other half earns as well, and if you have children, because of course they're a responsibility and you need to be sure that you can pay the bills for them as well.
Absolutely.
And then once we've established how much you earn, we can actually look and see what level of mortgage you can afford from there, based on the income. And what we try and do is find you a big enough mortgage to get you what you want. So the mortgage is the amount the bank or the building society lends to help you buy the house.
Yeah.
And the rest is the deposit that you put in or family help you put in.
Now, in terms of looking at the property itself, I mean, in your experience of advising people when they look for a property, is there specific types of property you will tell them it's a no-go area?
It's down to the person, because we're led by what the person wants and needs more than anything, because that's what we do, is we find something that's individual to you. But there are certain types of property that are more difficult to get mortgages on. So for instance, it's much easier to get a mortgage on a fairly new, nice, well repaired property that's in good condition, compared to a property that's really falling down, got damp and broken windows and things like that. So often a good property is one which is in good condition. Sometimes not too new, because sometimes when it's new it can be a little bit more expensive than it should be. So perhaps not too new, but it doesn't stop you having a new property. Also, we would look for different things that would be important with the property that would help you. So one of the things, if the property was in, let's say it's over a big commercial shop of some sort, like a garage, something like that, that would be much more difficult to get a mortgage on.
Why is that?
Because they're worried that there would be noise from the garage, fumes from the smoke, and it would be more difficult for you to sell in the future.
I see.
And then if you wanted to pay the mortgage back, it would be harder.
I mean, how about council flats, ex-council flats? I know. I mean, people are buying ex-council flats, but do you really think those properties carry value for money?
Somebody a long time ago in the county I come from, which is called Somerset.
Yes.
Over in Somerset, somebody actually explained to me, it doesn't really matter about what the thing is you're looking at. It comes down to the deal.
Okay.
So if the price is good enough on a council flat, then there's every reason that you should try and get it. It can be a little harder to get a mortgage on a flat which is a council flat, but by no means impossible. There are plenty of places will do it.
All right, so we've covered types of property. Now let's move on to types of mortgages.
Yes.
I'm sure you can tell us a variety. Go ahead.
Yes. Well, there are a number. The traditional mortgage, which generally we feel is the best one to have, is called a repayment mortgage.
Why is it best?
Well, what happens is that you have, let's say you borrowed £100,000 to help buy a house, and family have put a deposit in to help, and you've got the deposit from working hard. The money is there. So you have a £100,000 mortgage. Perhaps you want to pay that off over 15 or 25 or even 30 years. And what happens is that each month you make a payment. The payment pays off some interest to the building society, or in some cases pays a markup to the building society, depending on the type of mortgage you have, because of course there are specific mortgages which go in line with Shahira as well, which we can also talk about.
What's Shahira?
Shahira is if you are of a strict Muslim faith and don't wish to pay interest.
See. No, of course, we must talk about that.
One of the things we take into account, you see, because we deal with you as an individual. So if you have strict and devout views and don't wish to pay interest to a bank, we arrange a mortgage with a bank where you pay a certain amount each month, but it's the value of the property and a fixed markup at the end, so that they sell you the property back.
But come on, I mean, Robert, you know that every single bank is really desperate for your money. There is no such thing as, faith, is there? I mean, I thought the money is money, and everyone, there may be interest, but I'm sure banks are gonna make money out of you one way or another.
Well, in all cases, when we're looking at this as financial advisors, we take into account your principles.
Right.
And that's very important because that's part of doing, because what we do is do something that you actually need and want. So if you have strict principles, whether it's investment principles
All right.
or it's the mortgage principles, we'll go to banks and building societies that will actually meet your principles
Fair
and
enough.
meet the rules that for instance, in the case of Shahira, that an imam would like.
Absolutely. I got
That
the
they would be
message.
happy. Yeah.
Okay. So then there must be other ones. We talked about Sharia.
Yeah.
We talked about repayment and interest.
Yes.
Now there must be tracker and interest only and all those
yes.
things. Tell
Yes.
us more.
I will. So if we start from the repayment mortgage,
Yeah.
the most important thing about the repayment mortgage is each month you slowly pay off a little bit of the capital
Yep.
and a little bit of the interest until the mortgage is fully paid at the end of
Yeah.
25 years. That's
Absolutely.
why we like that.
That's a standard one.
That's the standard one. Now, you can have others which are simply to do with paying interest and then you pay the money at the very end. So much more risky thing to do because you have to have the money at the end and you have to be really sure you can get it. So that's quite important. But there are many ways of actually having a mortgage. Another popular one is what we call an offset mortgage. The offset mortgage is one where you actually have a bank account and also the mortgage together in the same thing. And what happens is interest on the bank account reduces the interest on the mortgage a little bit. So there are many ways of doing it. And that takes us then to the thing you've just described, which is fixed and tracker mortgages.
Right. Okay.
And what happens is that once we've established the sort of mortgage you need, whether it's repayment, interest only, offset, Islamic, or whatever,
Absolutely.
what we then do is then look at the deal that we can get. And the deal is a very old-fashioned way of saying it. It could be a car you're buying now, but the deal that we get you then has different ways of being put together. One of them is that the building society might say, well, we'll charge you the same rate of interest and guarantee it for 5 years. Now that's a fixed rate mortgage. Another building society...
Fixed rate because it's fixed for a specific duration.
Exactly.
Perfect.
Yes. Now another building society will perhaps say something different. They'll say, well, we'll let the interest rate vary, but it will vary in line with the Bank of England rate.
Why is there a connection between Bank of England's rate and the actual agreement that you have with the lender?
Well, the lender ultimately, in many cases, gets money from the mortgage markets, and it links its interest rate to the Bank of England rate, so that the rate at the moment is one which has been there in place now for a number of years. 0.75% has been there for some time,
Right.
and often if they're getting money commercially, they will link their rate to that rate.
Right.
But also, because it's a very convenient way of people understanding it, a lot of building societies which don't get the money that way, they get it from savings within their own organisation. That they have savers come along and they pay interest for that. They actually take the money from those savings, or a little bit of those savings, so that they can lend it for people. And when they're doing that, again, they'll often link a rate to the Bank of England rate because it's a way of everybody understanding it.
Right. So Bank of England is the, I suppose, the bank by
It's the benchmark, really.
benchmark. Okay.
Yeah.
Okay. So I mean, we talked about kind of types of mortgages. We talked
Yeah.
about different types of property, actually. Even now, moving on to, let's say, credit worthiness.
Yes.
I mean, how do you know whether you're worthy of getting a specific credit?
Well, the thing to do is to have a word with a financial advisor
Right.
or the bank or a qualified person,
Yeah.
and they'll have a look at your finances and they'll be able to probably give you an opinion just from talking to you first of all about how sensible things are.
Yeah.
What will happen next is that you can have what's called a credit score. Now, what that is a record of how well you've looked after your money, and if you've borrowed something on a credit card, how well you've paid it back.
Yeah.
You had a mobile phone, how well you've looked after it.
Yeah.
Sometimes a mail order catalogue, how well you've looked after that, and made your payments on time, and kept the balances down and slowly paid it off.
Right.
No, you might still have balances on it, but in other words, you might not have paid it off. But if you've made a good job and looked after it, then that will be something that will be assessed, and it creates something called a credit score.
Right.
And that can be obtained from what's called a credit reference agency, and there are a number of well-known ones.
Could you name us a few?
Yeah, I will. Equifax
Absolutely.
is one of them. There are many others. Probably the best known one is called Equifax, but there are others, the Hunter Group. There are a whole range of well-known. Experian, of course, is
And
another
Core
famous
Credit, I
one.
suppose. He's changed his
Corporate,
name recently, I think.
many change their names.
Mm.
So, but there are a number of well-known credit reference agencies will give you an idea of your credit score.
Absolutely.
And that's quite important.
And why is it important for people like us to check our rating regularly?
Well, it is important because sometimes without you knowing, there can be changes in your credit rating because of a mistake made by somebody else,
Yeah.
because of somebody impersonating you,
Mm-hmm.
which can happen, or because you've forgotten something.
Mm.
For instance, you've forgotten to make the last payment of a few pounds on your mail order catalogue.
Which could easily happen.
Happens a lot. And suddenly you find that will affect your credit rating because, of course, you haven't paid off the agreement that you had. So those things are very, very, very important because they do affect your ability to get a mortgage. And the reason for that is the building society will do its own credit score. In other words, it will look at your credit.
Yeah.
And what it wants to know is that, well, we don't know this person. Will he be reliable in paying his mortgage off? So they have a look and see how you've handled previous credit arrangements or how you've handled your money, and whether you've built up a deposit and whether you've built it up yourself or whether family have given it, which is fine, but how you've got it. And then they'll say, well, that helps us know whether we can give you a mortgage and whether you'll be able to make the payments without having to worry. Because that's the biggest thing they want you to be able to do is to be able to pay it,
Absolutely.
but not have to be stressed about it.
Absolutely. So, I mean, speaking of stress and strain, I mean,
Yes.
naturally, when you are applying for your mortgage,
Yes.
you assume to be feeling in a very good mood because you think, you know, the world is your oyster. But naturally, things do go pear-shaped sometimes.
They do indeed.
So, Ned, when we're talking about you losing a job,
Yes.
so what responsibility does a mortgage lender have when something like that genuinely happens?
Yes, there are several things. You can have, although it's less popular at the moment, you can have sorts of insurance that help you if your job fails.
Yeah.
And there can be state benefits in certain circumstances. Even compensation from an employer sometimes if you're made redundant in certain circumstances. But the most important thing is if you have a problem paying your mortgage, first of all, not to panic. Because, of course, the first thing, what people don't realise, Ripon, but you'll understand, and other people who talk about debt as we do, is that debt is very frightening.
Of course it is.
It goes wrong.
Of course it
And
is.
the first thing that happens is people are frightened. So, first thing to do is not to panic, and then look calmly at what's happening and whether you can manage to pay the mortgage, perhaps some savings until you get another job.
Absolutely.
Or if family can help and other things, or if you can get state benefits. So checking at the job centre to see if state benefits are possible.
Yeah, you might have to apply for universal credit.
Exactly, and you could that could do it.
Absolutely.
So there are a number of things you can do. Now, as soon as you realise, well, yikes, I'm not going to be able to manage this at the minute, you should pick the phone up and start to have a conversation with the building society. They'll be very helpful to you and very keen to talk to you, and it's not as frightening as it looks. That once you start, and if it worries you that you can't do it, have somebody like me do it for you, or have a friend or somebody in your family do it, and actually talk on your behalf to the building society, and you can give permission to do that. But best if you can do it yourself. And if you can talk to them, often the building society will say something, well, can you pay a little bit at the moment just to keep everything going?
Absolutely.
And if you say, well, if you can manage that, that's super. Sometimes they'll say, well, perhaps if you want to leave it 3 months, we'll give you what's called a payment holiday. And that's often very convenient. If you've worked hard and you've been paying your mortgage off a bit quicker than normal, they'll often say, well, we can give you a few months leeway. We don't pay anything for a few months.
But does that mean the interest still accumulate or what?
Oh, yes. Yes. Now, in most cases, the interest will still accumulate. If you were to really have problems with debt, where you say, well, I really can't pay this, it could be that what they'll do is start to talk about, well, what other ways of collecting the debt.
Such as what?
There are two main ones. They would either use an agency that will help collect the debt over a longer period of time. In those circumstances, as with consumer credit, the interest rate will freeze in there, and may not even be charged at all at that point. The other thing they can do is to start proceedings to actually take the house back so they can sell it, and that's called a repossession. Now, that really is best avoided because it will affect your mortgage into the future, but that's quite a long way down the road, so you've got a lot of time, a lot of talking, and a lot of things you can do before you get to that point. One of them, for instance, being sell the house yourself and move back in with family for a while.
Why is that important? Why selling the house yourself is important?
Well, there's a difference between selling a house that you own and that you're in commercially than somebody else selling it because they need to get some money back. The reason behind that is while in both cases you try and get the best price, you'll always get a better price if you're doing it yourself or you've got an estate agent doing it than if they just want to get the debt back. Because if somebody just needs to get the debt back and they get an offer that's there or thereabouts, a responsible offer but quite low, it might be if they've got 50 properties they've got to get rid of, they'll say, well, okay, we'll just take a low offer, if you know what I mean. Whereas you might be in a position, if you're selling it, to say, no, I'm not taking that low offer, I'm going to wait till the next person comes along. So that's, and probably what will happen is when you say, no, I'm not going to take that low offer, the person you're talking to will say, oh, well, here's a higher offer then in that case. But that isn't necessarily the case in a commercial organisation because the pressures on them are different.
Okay, so I mean, naturally, I mean, there will be scenarios where you do find yourself in conflict with the lender.
Yes.
I.e., the lender has behaved unreasonably, or it doesn't communicate, or whatever it may be.
That's right. Yes, that's very common. Yeah.
Are there any channels that the person who's got the mortgage can do, like any complaint process?
Yes, there are several, and I would say that the key word that you said there is communicate. If you're having either debt problems or they're just problems with the lender, getting in touch with them and talking to them on the phone is a very, very, or by some other means, or going in to see them if they're on the high street. All of those things are very important. So communication is critical in all of these things. So that's why I say, don't be frightened, don't panic, just talk to the lender. Now, if the lender's, in another context, the lender's made a mistake, or they've done something wrong, you can complain to them, and they have to follow a certain process. So, for instance, if you have a complaint against them because they've made a mistake of some sort, and they haven't behaved properly about it, you can write to them and say, I'm really complaining about this now, I'd like you to do something about it. And they have to make a note of it, acknowledge it for you, and they have to then write back to you and say, well, okay, this is our answer, we've investigated this properly, here's our answer. Now, if the answer is a good one for you, that's solved it. If the answer isn't and you're not happy, you can go, in the case of the Building Society or bank, to the banking ombudsman, who is a government official who is there to be an arbitrator. He's going to decide whether that is if your complaint is right.
Fantastic. Before we go, Robert, is there any last pieces of advice that you want to give to the listeners?
Well, I would always encourage people to, if you can manage to get a mortgage and you can own your own property, that's a wonderful thing. And it's a very happy place to be as long as you can afford it and pay for it, and it doesn't worry you to pay, you're paying too much. Then that's a super thing to do. And of course, it allows you later, when you've paid a little off your first house, to have another house and a bigger house again. And that's always a nice thing for people. And what we're about as financial advisors is exactly that. We try and find things that suit you and make things better for you in the future.
Fantastic. Robert Parker, thank you for coming from Chair of Personal Finance Society, and of course he himself is an independent financial advisor. Thank you for coming.
Thank you very much for having me. Thank you.
Listeners, so just after the break we'll be moving on to talk about housing and homelessness.
That was good fun.